All right. Now, this is an example of a weighted average problem. You're not going to see, this is not related to financial aspects, right? Obviously, I'm talking about test scores and colleges and home cities right here. If you are super familiar with weighted averages, feel free to skip and move on to my example of WACC and all that. But weighted averages pop up on FAR and they pop up on BEC a good amount. So I want to address them here for anyone who's not familiar. Why not just do a normal average? Well, because if you give the same weighting to, someone, oh, I'll show you. I'll show you. I'm getting ahead of myself. I write these examples for the purposes of teaching, but then I try to explain it before the example. It's just gotta use my own assets I'm using. So to assess test scores in a college classroom by the home city of each student, the class has 100 students total. The weighted averages give a more accurate result than normal averages. So the purpose of this, we want to assess those test scores and see which city is the stupidest. So which city did the best? Oh man, see what cities I picked here. Hopefully I don't get too much flack. So the class has 100 students total. Weighted averages are a more accurate result than normal averages. Let's see. All right, I picked New York, Kansas City, and Tampa Bay. Got connections in all these places. They've all lived here in all these places throughout my life. So if any of you are in New York, Kansas City, or Tampa Bay, I have love for all of these places. Now, in this theoretical college classroom, we've got 25 students from New York, 25 Kansas City, and 50 from Tampa. The average test scores we have here are, on average, students in New York earned 90% on the exam. In this college class, for Kansas City, it was 95%, and for Tampa Bay, it was 85%. Tampa, I love you. Great city. I guess everyone was at the beach too much and partying at the Gasparilla Festival. Oh well, better luck next time. But all right, all three of these are going to be calculated, right? So we are going to take our weight times our factor. Now in the WACC formula, it's going to be weight times cost. So your weights are always going to equal 100%, as it should, right? What's the weight of each item here? We have 3 items. Well, 25 divided by 100. Now, these don't have to be clean numbers like this. It could be 35 divided by 100. Maybe we bump this down to 15, right? We can mess the numbers up a little bit. This just happens to be 25, 25, 50. Now, on average, New York got 90%, so 90% times 25%, 1/4. So we are weighting it. We are weighting it according to how many students in the class are from there and got that grade. So there we go. 95 times 25, 85 times 50. Add them all together and we get 88.75. Now let's just do a quick weighted average here. If we just did, sorry, not a weighted average, let's just do a normal arithmetic average. So if we did 90 plus 95 plus 85 divided by 3, which is normal, we would get a score of 90. Now, you could have just said, all right, eliminate these two and get 90, right? But a weighted average takes into account other factors. It's more dynamic, more accurate. And that's why we use it so much on the CPA exam. All right, now that we went over how weighted averages work, we'll obviously do one that is like you'll have to do on the exam. It has our WACC, right? It has our components of capital, cost of capital. Just wanted to make sure that everyone understood how to go about that overall. Because you could use that for weighted average shares outstanding, for EPS, and all of those formulas in FAR. We are going to use weighted average as well in a few other places throughout both exams. Now, what is the weighted average cost of capital? As I mentioned before, it's the average cost of all forms of financing, and it is often used as a hurdle rate. Now, again, this is you got to hurdle over, right? You got to break even, you got to get over that. So it's weighting your equity, right? Because you raise cash through selling stock. You can raise cash through debt by using bonds, and you can raise cash through preferred stock. And you are going to weight these. Now, generally, what is the cost of debt? Generally, that's just the interest rate, right? That's what you pay. Same with preferred stock. It's generally, right, like I mentioned, it's the same thing. It's a fixed payment, so that's the cost of the preferred stock. Now, conceptually, what is the cost of equity? And that's why cost of equity has a few ways to determine what it is. Now, the cost of equity, it's not as simple as just looking at the interest rate that you're paying out or the payout rate. So a lot of times it'll be provided for you, or you need to use one of these valuation formulas. The main three being the CAPM, DCF, discounted cash flow, and bond yield plus risk premium to determine the cost of equity. In the real world, there's other ways to do it, and it's not as easy as just saying, oh, it's what you pay in interest, right? It's got a lot of other factors. It takes into account the market, right? Potential gains of the stock, because you're giving up your stock that you could have had gains on if you held it yourself as a company. And keep in mind that a lower WACC is preferable, because that means the money that you raised in order to get cash is cheaper, right? Cheap money is good money. All right, so cost times weight, cost times weight, cost times weight. That is our formula. Add them all together, and that gets you your WACC. Just to say it again, all the weights are going to equal 100%. So maybe this is 80, maybe this is 20%, maybe this is 0. There will be plenty of questions where it's just equity and debt. Some other questions where it's equity, debt, and preferred stock. Just depends on what you see. Now, last point here, after tax. It's after tax cost of debt, because we are calculating that interest expense is tax deductible. Cost of equity, as I mentioned, we've got 3 different ways to calculate what this amount is, right? So maybe you pay 10% interest, so we know it's 10%, right? You pay 7% of preferred stock, so that's 7%. Now, calculating this is a little more complicated. We need to either use the CAPM, the capital asset pricing model. So, right, I say WACC and CAPM, super important on the exam. Well, CAPM is a way to calculate the cost of equity. There's a lot of synonyms here. But we could say cost of equity also, and we'll mention this, this is also known as the cost of retained earnings. It's another name for it, right? Cost of retained earnings, the cost of stock. We've got CAPM, DCF, other ways of cost of equity. These are all methods of calculating that, right? Synonyms, essentially. So, CAPM first. And you could have individual questions on CAPM. You could have a whole big WACC formula where you have to get all of these, and you have to do WACC, CAPM just to get the cost of equity, plug it in, and get all of these together. So different ways this could be asked. Now, for sure, memorize all the formulas. All the formulas you see here, definitely memorize them. That's the bare minimum. Like, you need to have them memorized. Otherwise, I don't go into the test without them memorized. That is the bare minimum. And then, obviously, we're going to work through them and make sure that you understand how we are going to calculate them. The most common to be asked in the exam is CAPM, followed by DCF, and lastly, bond yield plus risk premium. Now, I was thinking about not even putting this one on here because it's just not, it is asked, but my goal here is to use your time as efficiently as possible. It's just, memorize it. I'd say it's worth it. So CAPM tries to value your cost of your stock. Now, it takes the risk-free rate and adds that back. Actually, I'll start with this. So market return. Let's say the overall market, the S&P 500, right, was the S&P 500. That's a basket of the top 500 companies in the United States. So the overall market, it's that's generally used as an indicator of the overall market, how it's doing. And if you can beat the S&P 500, well, give me a call. I'd love to invest in your strategy. So the S&P 500 is making, let's say, 12% a year. Risk-free rate, as we mentioned before, it is the rate you could just get in treasury bonds. Usually, if the question mentions treasury bonds, this is going to be what you'll use. So we're getting 12% on the market, and treasury bonds will give you 3%. So that means it's literally risk-free. You can just get 3% by doing nothing, by buying treasury bonds. Now, another way they could refer to this is the market risk premium. Now, what does that mean? That means you're risking your money in the market and earning a premium of 9%, because you could do nothing and earn 3%, but you are choosing to risk your money, put it in the market, and earn 9%. So again, not to trick you. I mean, the question will try to trick you. I'm not trying to trick you. It could give you the market risk premium and not give you any of these, and then you'll have to calculate it using that. So in the parentheses, this is market risk premium. It's the amount you're trying to get over the risk-free rate. That's 9%. Beta. What is beta? This is essentially a metric of how volatile, and volatile means how much it fluctuates. It goes up and down. How volatile it is compared to the overall market. So Generally, this is going to be like, say, 0.5 or 0.75 or 1.2. So 1 is the overall market. And, if let's say, the overall market goes up 1% each day or goes down 1% each day. So like a little bit up, a little bit down. Here's the overall market. Here's just a straight line. And then your stock goes all the way up and then all the way down. So obviously that's a lot more volatile than the overall market. That's what beta tracks. I'll go over that a little bit more at a later point as well, in terms of higher than 1, lower than 1. So that is beta. Just it'll be given to you. You don't have to calculate what it is. It'll be given to you. And then you add back in the risk-free rate. This is a formula. Memorize this. It will get you so many free points on the exam. Now, the DCF, the discounted cash flow model, this is another metric of trying to value stock, it's a valuation metric. It could be seen in the valuation section or lesson as well. And this is essentially trying to calculate based on dividends, cash flow received, D1 divided by price, the stock price. So dividends divided by price plus the growth rate. This is trying to calculate our value of our stock, right? And that can be used as the cost of equity. Lastly, our bond yield plus risk premium. Market risk premium. This is what I mentioned before. So again, if it wants you to calculate the bond yield plus risk premium, and it doesn't give you this, but it gives you market return and risk-free rate, you know how to calculate it. And it's trying to say, okay, bonds, they're pretty safe as well. Not necessarily safest, but right, it's fixed income. So what is the cost of debt plus the premium you're trying to get on the overall market? That's what the bond yield plus risk premium does. It's in the name, right? What's the yield you're earning on a bond plus the risk premium that you're trying to get through the market? So this is another way you could calculate it. Pretty simple. You just take our cost of debt, and add the market risk premium. Cost of debt. Now, how do you calculate that? And sometimes one might be given to you. Just keep that in mind, right? Maybe they'll give you the after-tax cost of debt, but you have to calculate cost of equity or vice versa. But if you have to calculate the cost of debt, well, you got to remember you got to get the after-tax cost of debt, and this is simply just the pre-tax cost of debt times 1 minus the tax rate. Cost of preferred stock, how do we get that? If it's not given to you, well, that's preferred stock dividends divided by net proceeds of preferred stock. And ding, 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 if you caught onto this, my favorite words, inflows, outflows, outflows, inflows. Preferred stock dividends are paid out, so this is outflows divided by net proceeds of preferred stock inflows, right? What you get in cash for issuing this preferred stock to investors. So again, outflows divided by inflows. That's the cost formula I mentioned earlier. So right there, you're seeing it already. You're seeing it displayed out, and just the relevance, right? Making it nice and simple. So that is the cost of preferred stock. For the weights, as mentioned, these are percentages that will equal 100%. So decimals that equal 1, we have 0.25 plus 0.25 plus 0.5. And then each cost will have a dollar amount that's a percentage of the total cost. That's the weight. So for example, if it says, okay, we have an overall, we're raising, $10 million, and let's say 2 of it is equity, and then 8 of it is debt. Gosh, don't you just love my nice clean drawing? So that means, well, if 2 million, we're raising 2 million cash from equity, 8 million from debt, that means the equity weight is 20%, the debt weight is 80%. Boom. Nice and simple, right? 2 divided by 10, 20%, 8 divided by 10 is 80%. And there you go. So note here, usually it's the actual interest rate is the pre-tax cost of debt. Nothing crazy, nothing too crazy. Now, let us see an example of this and run through it, similar to how we did with the college student example, but now we're actually using our financial metrics that we are going to need to use for the exam. Let's run through our actual WACC example. We're going to be using the same percentages, 25, 25, and 50. And in this case, we are a company. Shocker, right? We're a company. In this case, we want to purchase a $1 million machine for the company's factory. Pretty reasonable request. As we mentioned, weighted averages give a more accurate result than normal averages, which is why we're going to use WACC. Now, as a company, let's say we have 4 different options of how we can raise this $1 million. I guess technically we have 5, if we had enough cash on hand, but let's say we don't have enough cash on hand to buy this machine in cash. Option 1, we issue $1 million worth of common stock. We give common stock to shareholders, they give us cash in exchange, we use it to buy the machine. Option 2, we issue $1 million of preferred stock. We give $1 million worth of preferred stock to investors, shareholders, they give us $1 million in cash. Option 3, issue $1 million of corporate bonds, meaning we give bonds to shareholders, we pay them interest, and they give us back $1 million in cash. All right, and now we have option 4. The reason I hesitated, I was going to make a joke about we just put the $1 million on a corporate credit card, but I guess I said it anyway. A secret option is use your credit card to buy the machine, but that's not an option. So option 4, issue a mix of the 3. We've got WACC. That's what's going on. That's what we're going to use. And that's a mix of using these 3. Now, why is that the case? Well, there's a million reasons why we do a mix of the 3. Maybe we want to just do a little bit of stock, right? Maybe we can only get a certain amount of debt. Maybe we can only do a certain amount of preferred stock. We only want a certain amount of debt because then that makes us look bad if we have too much debt in our balance sheet. There's so many reasons why. We've also got bank covenants, debt covenants. We will talk about those as well, where essentially you need to maintain certain ratios in order to be able to get funding. So meaning we can't have too much debt. So that's why we would do variations of these. Our example is going to explore option 4 because if we chose options 1, 2, or 3, it would be pretty dang simple. It would be very much just doing these. We wouldn't have to do any weighted average. So as we mentioned, our weighted average cost of capital, or WACC, is the average cost of all forms of financing, often used as a hurdle rate. Now, similarly for you, you could have a WACC in your personal life. Maybe you have credit card debt, student loan debt, mortgage. You just weighted average cost of capital, all of those together, and you get your own personal WACC. There you go. Relate it back to yourself. And as we said, WACC is the cost of equity times the weight of equity, after-tax cost of debt times the weight of the debt, and cost of preferred stock times the weight of the preferred stock. Let's do it. All right, well, now we've got our example. Let's dive in. Equity, preferred stock, and debt. Well, here we are going to raise $1 million through a combination of these 3. Equity is common stock, preferred stock is, remember, our customized stock, and then debt, we're going to use bonds, not the company credit card. All right. If anyone gets a credit limit of $1 million, please let me know. That sounds like an interesting story. Well, the costs can be provided, or you might have to calculate it. Maybe you have to use the CAPM to find this one. We'll talk about how to find the cost of preferred stock in a future slide, and cost of debt. And we'll go over all 3 of these in more detail for sure. But just like a nice intro, some questions will be given to you. In this case, you do have to find the weight because the question will tell you, well, we raised $250,000 in equity, $250 in preferred stock, and $500 in bonds. Well, total value is $1 million, 25%, 25%, 50%. Same percentages as the student example. And as we mentioned, our formula, it's the cost times the weight, and cost times the weight. Total here is going to have a WACC of 9.5%. Again, just to recap, this could get much more complicated, and not in a bad way, right? Once you get the system down, it's not like they can throw disgusting tricks at you, but the most complicated it could be is you have to find this using CAPM or discounted cash flow, find this using our formula, which we'll talk about, find this using the pre-tax cost of debt, then you have to calculate the weight, and then combine them all together. So it could be lengthy and for sure be a sim, but in my mind, this is nothing too crazy once you get it down. And it is super important on the exam, so worth your time to study. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.